Tomorrow morning, before the market opens, Delta Airlines reports second quarter earnings. The stock has ripped higher this year and now trades near record highs at around $87. And Wall Street is all in. 24 of the 27 analysts covering Delta rated a buy. But airlines hide a trap that catches investors at exactly this point in the cycle. And when I ran Delta through a model built to avoid that trap, fair value landed nowhere near $87. So before the numbers drop, let's stress test this rally. First, the bull case, because it's real. Last quarter, Delta delivered record revenue of $14.2 billion, up 9.4%. Adjusted earnings per share hit 64 cents, up 44% from a year ago. For the quarter reporting tomorrow, management is guiding to around $1 billion of pre-tax profit, while swallowing more than $2 billion of extra fuel costs. The balance sheet is the strongest in Delta's history, with net debt below 2019 levels. That's why the average analyst price target sits at $93.60, about 7% above today's price. It's a clean story. Now let's test it. Here's what that story skips. Airline earnings never sit still. Over the past decade, Delta's net margin peaked at 11%, collapsed to negative 72% in 2020, and has clawed back to about 7% today. That's not a growth curve, that's a cycle. And the trap works like this. Near the top of a cycle, inflated earnings make the price-to-earnings ratio look cheap, right before margins revert. So this model refuses to value Delta on today's earnings. It rebuilds them from the 10-year average and prices them at the 10-year median multiple. Method 1 begins where a cycle can't hide the truth. The top line. Delta's trailing revenue is $65.2 billion. Apply the 10-year average net margin of 7.1%, and you get $4.63 billion of normalized earnings, about $7.12 per share. Price that at the 10-year median multiple of 8.9 times earnings, and Method 1 lands at $63.38. That is 27% below the market. Method 2 runs the same idea through the enterprise lens because airlines carry heavy debt. The 10-year average EBITDA margin of 14% gives $9.1 billion of mid-cycle EBITDA. At 6.5 times, that implies an enterprise value of $59 billion. Now subtract $9.1 billion of net debt, divide by the shares, and you get $77.28. This method is more generous, and it still sits 11% below the market. Blend the two methods 50-50, and normalized fair value lands at $70.33. Against a price near 87, that is roughly 19% of downside. On mid-cycle math, Delta is overvalued. Now the honest counter. If Delta's best ever margin, the full 11%, holds forever, this same math reaches $99, 13% above today. So the current price isn't crazy. It's just a bet that peak margins are the new normal, not the top of a cycle. One detail worth weighing before you take that bet. Over the last 12 months, 10 Delta insiders sold about $65 million of stock. Not one insider bought. That proves nothing by itself. But it is not the behavior you expect at the start of a boom. So here's the setup going into tomorrow. Delta is priced for peak, about 19% above normalized fair value, and the swing factor is fuel, with guidance built on $4.30 a gallon. Tomorrow, the market finds out if peak margins can hold. This channel does one thing. It stress tests the Wall Street rating against the math before the crowd does. Subscribe, and the next name lands on your feed before its earnings. Until then, that's the valuation verdict.